retirement planning is not a retirement plan. Retirement planning is everything, whether it's outside investments, outside stocks, outside bonds, crypto, real estate, private equity. You were talking about on your thread the other day about getting great rates of return. A lot of those comes from private equity opportunities. And there's tons of ways to have a retirement that is called full income replacement.
Hello there, Orthopreneurs, and welcome to another episode of the Orthopreneurs podcast. Today, it's our two-time returning champion, Dr. Mart McClellan. Welcome, Mart.
Hi, Glenn. It's great to be here.
Oh, it's a pleasure to have you because we had you on the podcast a while back. It was great. Anybody here wants to hear some great stuff, go listen to that podcast, the first one we did. A lot has happened in the world since we did our first podcast. And as our conversation evolves today, I think people are going to see some really interesting conversations we're going to have about the economy, about alternative investments, about wealth management, about cryptocurrency and what it really means, blockchain, however we want to talk about that discussion. I know we're both passionate about that conversation. But let's start here real quick. If you can give me that 30-second summary of who people already can listen to the first one, but who are you? You know, I know you're an orthodontist and you run, you're founder of Macro Wealth Management. But other than, how did you end up where you are? What's your 30-second elevator talk?
Yeah, I never in a million years imagined that I would be a financial advisor for my fellow colleagues, orthodontists and dentists for the most part. But I was fortunately introduced to a gentleman about 25 years ago who was a financial advisor. He showed me a sort of a different way of looking at things. And because I was realizing the traditional way of financial planning did not work and it wasn't working for me. And after sort of engaging his services as a family member and my wife and kids after 7 years, I said, hey, would you mind if we sort of brought this information to the healthcare world, mostly orthodontists, of course. And so we started Macro Wealth 20 years ago, 2004, and never looked back. And so that's sort of the exciting thing because it's ever evolving financial world we live in, and it's always changing. And you always have to stay on top of it.
Amen. And the best part is for people who are, another conversation about financial management. That is not going to be today, folks. Yeah, exactly. This is not your grandfather or even your parents' financial management conversation. We're going to throw stuff out there that I guarantee you, some of it may be foreign to you or at least really interesting. So let's talk first about, let's start with the big pink elephant in the room, the blockchain and cryptocurrency. Now, the goal is not to jump in and explain what blockchain is. I'm not going to get into that one. There's so many resources out there that, again, I mean this politely. If you don't know what blockchain is, go look it up at this point because it's not new. It's been around. My question for you, though, real quickly, Mart, just a quick, simple answer. Do you feel that blockchain as a whole, for its security purposes, its record-keeping purposes, not as a currency, but as blockchain for the sake of blockchain, do you feel that it is today what people were touting do you believe its potential today the same way you might have felt 2 or 3 years ago?
Yeah, I'm even more bullish on the blockchain today than I was 4 or 5 years ago. I do believe we're sort of at the changing point like the internet was in the mid to late 90s. I think we're at the same type of changing point in the blockchain. So I think everything is going to be moving in that direction in the years to come. And so it's something that's certainly not going to be going away.
Okay. And I'm gonna do something I swore I wouldn't do about 3 minutes ago. So for those of you who, I'm gonna give you the 50,000 foot view of blockchain in a very quick, probably 2 sentences or most. But blockchain is a method of, I don't want to say encryption, but it's peer-to-peer relationship where everybody shares all the data all at once, so the record becomes immutable and unchangeable, so that you can't just go change the record and suddenly everybody looks and goes, wait a minute, something has changed. So it's valued as a security measure more than anything to be able to protect immutable records. Did I say that okay?
No, you nailed it. Yeah. Okay. The immutability of it is the big piece of the equation. Right. Can't be changed.
And the chain gets longer and longer by, as you guessed it, blocks. So blockchain. And the work that is created within the blockchain turns off currency, right? That's the nature of how it works. And that's cryptocurrency that evolved from the blockchain. So there's many different types of currencies out there as a function of different networks, different everything. But we won't get into that today because, again, if you haven't heard of cryptocurrency or haven't done a cursory sort of dive into what cryptocurrency is, go do it and then listen to the podcast. Cryptocurrency, are you as bullish on it today as you were, say, 3-4 years ago?
Even more so, even more so. And one of the big reasons is because in years past, everybody was always concerned about it's not regulated, it's not safe, it's really super duper risky. And the institutions were not really engaged in it. The government didn't like it. But
Which is all true 3-4 years ago.
Oh yeah, and it was a scary world. And but the government, SEC, they engaged it finally. And earlier this year in January, they accepted Bitcoin as an ETF. And so now people can engage cryptocurrency and Bitcoin just doing a normal investment through their broker, whether it's their person through Fidelity or other places to get it into their portfolio. So it legitimized the blockchain in a much greater way. And now Ethereum, the second biggest crypto, also has an ETF. And so it's becoming more and more accepted in the world we're living in. And even you're starting to see some of our politicians talking about it now. So that's sort of be providing some more legitimacy to the space.
Well, but Mart, isn't cryptocurrency really dangerous? Can't you lose all your money in cryptocurrency? I mean, I remember what I'm trying not to laugh. Okay. There are people, this is a legitimate question that people are going to ask, right? Yeah. Your patient comes up to you and says, blockchain, I don't know anything about that, but I have heard of Dogecoin, right? Because of Elon. Mm-hmm. But I know about Bitcoin. I've heard about Bitcoin. And I remember everybody I knew who had it lost all their money. It's a game. It's a joke. It's a Ponzi scheme. There's no reason anybody should be with Bitcoin. What would, again, you're at a party. You don't want to rock the boat. You don't want to make a big scene. What's your answer back to somebody who says, can I really trust this stuff?
Well, you can absolutely trust it. It's not going away. It's getting stronger and stronger each and every day. And if you do have some concerns about losing it, because it can be, there are some nuances to how you store your crypto, right? Whether it's through things called hot wallets, cold wallets. There's a number of ways to do it.
Take a minute, if you don't mind.
Yeah.
People out there who have, I think this is really important because, you have grandma who has her $1 million in cash stuffed in her mattress because she doesn't trust banks, mm-hmm. right? You've got people who have their stuff in online institutions in terms of regular money, fiat, if you will, mm-hmm. And there's people who have air gap, right, stuff. Yeah. There's different ways that you can manage your money and protect it. I do mm-hmm. think it's worth you taking a minute or two and explaining to people what a hot wallet is, what a cold wallet is, so that they can understand fundamentally how they should store this stuff. And secondly, do you feel it's still risky from an investment perspective? It's safe if you store it properly, but as a risk, is it a super mm-hmm. risky investment?
Yeah, so great questions there. So on the front end, I guess the big thing about crypto on the front end is you need to go through a centralized exchange initially. And usually Coinbase is the best onboarding ramp for actually investing in crypto.
Stay away from FTX.
Stay away from FTX. Yeah, that oh boy. And there lies some of that risk, right? That's where
right. I lost a lot of money, but they're making people whole again.
Yeah, or BlockFi or Celsius. These things are the ones that sort of create that risk where you can lose your money very quickly. And but it all starts with sort of the onboarding with Coinbase, or there's other ones, but let's just use Coinbase as an example. But that's a centralized exchange. And so anything that's centralized, like your bank, your financial institution, that's a centralized entity where your money can be confiscated. If you don't want your money to be confiscated, you can offload it from those centralized exchanges to decentralized areas. And there's two places it can go, a hot wallet or a cold wallet. And what that is, a hot wallet is nothing more than a connection to your desktop computer. And so you can move those cryptos from Coinbase onto software program on your computer. And it's all yours as long as you have the keys, the seed phrase is there. It can't be taken away from you.
Do not lose your keys or seed phrase, because if you do, what happens?
They're just saying out there, it's not your keys, it's not your money. It's gone. So you need to keep track of that. But the safest way, of course, because if it's on your desktop, things can happen to your computer if you don't keep your key phrases and seed phrases, is to have a cold wallet. And actually, I brought my cold wallet. This is a cold wallet right here. It's called a ledger.
For those of you who are listening, it looks just like a thumb drive.
Yeah, it looks like a thumb drive. It just unwinds here and looks just like this.
And it's a digital. So when you plug it in, it asks you to enter a series of things.
It's just load password, and then you can load your crypto, your Bitcoin, onto that little USB type device, and that's like having a bar of gold. Like if people invest in gold or silver, they put the gold and silver into their safety deposit box, and it is as safe as it can be, and nobody can take it from you.
Yeah,
So
and the
that
only difference is that if someone takes your gold, they can go use it. Someone steals your cold wallet, there's nothing they can do with it.
that
They,
is
they're,
not. It's
they're
even
never
safer.
going to crack it
They
ever.
can't crack it. They cannot.
Go ask the people. I don't remember the number. How much Bitcoin is now considered to be gone forever because people lost their. You remember the number?
It's about 20%. They think it's millions and like 4 to 5 million maybe are gone forever. This
4 to
one
5
guy had
million.
thousands of. He lost his computer in a trash dump. He's trying to recover it. It's probably never going to
Yeah,
happen.
4
So
to 5 million Bitcoin people,
Bitcoin,
not 4 to
Bitcoin.
5 million dollars.
No.
4 to 5 million Bitcoin are gone forever because
Mhm.
people lost their key phrases or their past. And the beauty of decentralization is the drawback of decentralization.
Yes.
Because if you have your money in your bank account at Bank of America, let's just say, and you forget your password, you click the forgot password button, and it does through 2FA or any number of series of ways. It finds you a new password, you create one, now you can log in. There's nobody to call, there's nobody to email. It
Yeah.
is decentralized. So when
You're
you
not
have
calling
your
Ghostbusters. You're not
no,
calling them.
you're not calling Ghostbusters. By the way, when you said hot wallet, cold wallet, I just went hot wallet. Every time I hear hot wallet, I can't think of that catchphrase from Hot Pocket. But
Yeah.
yeah, if you lose, your kid comes home, from school, and he or she, they're 5 years old, and they see daddy's hammer on the workbench, and they take it and they smash your cold wallet, and it's smithereens. You just lost all your money.
Yeah. Yeah.
There's
And
nothing you can do.
you have to be very careful. So people who are a little not comfortable with that, well, that's all been resolved with these ETFs. Oh, there he is. Here we go. And then that's a great way of storing those phrases.
That's for people who are scared of the scared.
Yeah.
So you can just for those of you who are watching, I'm not going to show you my seed phrases if you don't mind. But this is by Keystone. You can buy it on Amazon,
Yep.
right? And all it is, and I'll show you just a little hint of it, right? So you can see. I don't mind showing you a little hint of it, but basically, let me put it over here so you can see.
Yep.
And it comes with little numbers that you can put in and words and letters to create. When you have your seed phrases, this is metal, it's stainless steel. You put all your seed phrases in here in little blocks. It comes with tons and tons of little metal. It's like an arts and crafts project. And you put all your seed phrases in there, and then you close it, and you'll notice, even moreover, if you're really nervous, that it comes with the ability to put a lock through this little corner. So you can lock this, put this in a safe somewhere so that you can keep your cold wallet or your hot wallet and be able to access it, always remembering your seed phrase. Because if I lose those and put them on a piece of paper and somebody pours water on it, the money's gone forever if I forget my password. It is definitely becoming more mainstream, but I think people need to be mindful. Maybe down the road, it would be fun, Mart, for you and me to do a webinar together for all of Orthopreneurs, not just
Yeah.
RD, to say, okay, you've decided you want to get into the crypto game and you want to learn more about it. We're gonna make a fake account, and we're gonna show you how we transfer it step by step, how we buy the asset, how we get funds into the asset. Can you trust Plaid? Can you not trust Plaid? How do we get the money into it? How do we buy it? How do we store it? How do we transfer it? What about seed phrases? And we can go through the whole. What do you think about that?
That'd be very valuable, because it's undeniable, in my opinion, that it's not it's the future of money, and it's not going away. And to the point on losing it and the seed phrases, if people are sketchy or a little concerned about that, that's where those Bitcoin ETFs and other ETFs that are coming on board, that takes away that whole equation, because those accounts are just like in your brokerage account they are today. So people say, hey, I just want to have some Bitcoin. You can get the ETF, which gets really to my next question you were asked. The back end of that third part is like the risk factor. Well, of course, Bitcoin is one of the most volatile assets out there, but the same token is the biggest returning asset in the history of investments over the last 15 years.
Is that true? I didn't know that.
It is. It's nothing's really been even close to it. And so, with the volatility comes great returns, but also great losses. But that's starting to level out as more adoption's becoming part of the equation. But the main thing about that risk is that there are research papers out there now, almost 10 years now, through Bitwise, that have been proven through research that if you have about 2 to 2.5% of Bitcoin in your portfolio, so we're not talking about a lot of the entire amount, but what it shows is that you can increase your rate of return of your portfolio into the teens, which is significant, without raising the standard deviation or the risk. So the risk is the exact same, but you're getting a greater return. So what that says is there's really no downside. Of course, this is not financial advice. Consult your advisor and all these other things that go along with these things. But there's research to support having some Bitcoin in your portfolio. If people are concerned about evidence-based, everybody likes evidence-based dentistry and orthodontics. Well, if you believe in evidence-based financial advice and other things, then it is available. And if anybody wants that paper, I can certainly send it to them as well.
Absolutely. I would love to shift a little bit now to the broader economy.
Mm-hmm.
The real quick answer, give me one sentence, is cryptocurrency better or worse in a good economy or a bad economy?
Well, back in the day, they considered cryptocurrency kind of an asymmetric asset, which meant it moved in a different direction than the stock market, which is obviously a really good thing. So if the market's going up,
Right.
Bitcoin's going down, and vice
Hedge your
versa.
bets like gold.
Yeah, right. So that was a very, very positive thing. But that is sort of a change now with the institutions coming on board and engaging Bitcoin. And so now it's kind of more together. And so it moves hand in hand. But typically, when inflation's running hot and the governments are printing money like they're printing, that's very favorable for Bitcoin and cryptocurrency. So typically, there's something in Bitcoin called the halving. Every 4 years, it gets halved. And usually 6 to 12 months after, or even 18 months after that halving, you start seeing some run-ups in the Bitcoin market. A lot of that has to do with how the economies and the governments are printing their money and playing with the interest rates, which they're doing as we speak.
You brought me right into the conversation I was hoping to hit.
Yeah.
And so let's talk about the economy, right?
Yeah.
What the old saying, it's the economy, stupid.
Yeah.
Let's talk about where we are, because I was speaking to Chris Benson not long ago, and he's one of the, in my opinion, in terms of just understanding the landscape of the orthodontic world and making predictions that actually come true.
Mm-hmm.
Chris has been as close to anybody as I've ever seen in my 10 years of doing what I'm doing right now.
Mm-hmm.
And his conversation with me really was, look, we've been in a recession, orthodontic recession. If you're up 20% or 25% year over year after year, good for you. You're not the norm.
Mm-hmm.
It could be what you're doing right. It could be the location or region you're in. It could be just your locale. But I think 22 was flat or down. 23 was flat or down for most. Yep. 24 is flat or down for most. He was showing me, if I'm not mistaken, I'm sorry, Chris, if I butcher this, but he was showing me 40 years of historical data about the economy and ortho results. And after there were 2 bad years in a row, it always exploded with growth in the third year. And now this could be our third down year or a flat year in a row. The expectation is that after the election, when there's some more sort of confidence of who's leading, right now, mm-hmm. whether you're Republican or Democrat, doesn't matter. We can acknowledge the fact you have a lame duck government in place, because mm-hmm. you've got a president who's not running again for office, who can only get so much done in the next 2 to 3 months. And so there's a lot of uncertainty in the world. There's a lot of uncertainty in the economy. And there are many, Chris was talking about, who believe that at the end of 24, early 2025, there's going to be some incredible growth, not only for the economy, but potentially private equity and all those other things. What are your thoughts as somebody who runs, a wealth advisement management company? What are your thoughts on what I just told you, and what's your perspective on the economy over the next 6 months, year? And I know we don't have a crystal ball. Nobody's holding this to you, but you are a hell of a lot more informed than I am, and I'd love to get your opinion.
I agree. Chris mentioned the orthodontic recession. I do believe we've been kind of in a recessionary period, even in our economy presently. This is an election year, of course, and so the government tries to do everything they can to boost up an election year. But the jobs report just came out, not falsified, but it was just a misrepresentation of the jobs report. I think it was 818,000 jobs were not created, and so that obviously kind of tells you we were in a recession or heading into one. And that's sort of our thoughts on that as well. And as long as the Fed, is sort of wanting to adjust interest rates, they're in the business of keeping people employed and,
Right.
keeping it full market. They're talking about lowering interest rates. Well, the Fed is stuck because they know if they lower interest rates, that's going to be good for the economy, but that also creates more inflation, right?
Yep.
And they can't increase interest rates because that's not bad for the economy. And they have nowhere to go, especially when the debt's increasing at $1 trillion every 100 days. It's an
A
unsustainable path.
trillion. Say that
Dollar,
again. A
$1
trillion
trillion
dollars
every 100 days.
every 100 days.
Yeah.
How,
So
how are we not bankrupt as a country?
so that's kind of the gorilla in the room that a lot of people aren't paying attention
And,
to.
and,
And
and the
so,
second question, how is our currency not so devalued in the international market that someone like China comes in and buys out our currency and owns us as a country?
well, that's happening. An announcement came out this week. I saw the BRICS group, which is Brazil, Russia, India, China, South Africa, and about 10 others who just recently joined them last year. They're looking to sort of offload the petrodollar, and they want to move towards their own currency to transact oil and all those associated things on their own in their own particular way, which is extremely bad for the dollar. I mean, it's really, really, really bad. And so these things are in the background, and as long as we don't keep those in our sight lines, it's going to have an impact on our economy in the future. I mean, the fact of the matter is, as inflation goes up in orthodontics, I mean, it is what it is. It's discretionary expense for most families across America. And can you wait 6 months for braces? Yes. And can you play with these payment plans? Yes. But people, they're struggling, and inflation, cuts across all those different segments of life. And you got to put fuel in the car and put food on the table, and braces can wait. And so I think that's one of the reasons why we've seen this sort of flattening of the growth in our industry in the last number of years.
And Chris was very clear in saying that it's his belief based upon the data and the numbers. And like I said, he's probably forgotten more about the ortho world than I'll ever learn. That these people, that the flat or the stagnant growth that people are experiencing is not because GPs are taking on tons more work. It's not at-home aligners, which is kind of done.
Yeah, yeah.
It's predominantly people, mostly adults, who are on the sidelines and saying, I'm not jumping and doing that. They're there, and they will be there when the economy turns around. It's not like, you have a pie of a certain number of people and a large part of it has just been taken by GPs.
Mm-mm.
No, his feeling is that all these people are on the sideline. Many of them are still paying for their kids to get treatment, but for adults, they're
Yeah.
sitting on the sidelines and they're just waiting. And as soon as the moment is right, they'll jump in, and we'll see them all get started. We'll see some great economic outcomes for orthodontists. And that if you're not doing amazing right now, don't feel terrible. It doesn't make you feel better
Yeah,
to know others are in
exactly.
the same position. But what you're experiencing is the norm right now
It is.
in ortho. It just
Yeah.
is.
And I think that numbers they said adult starts are like down over 20%. I mean, so I think that gives you an idea of, where people, to your point, that they'll get braces for their kids for the most part, but they can wait themselves. And
Yeah, exactly.
we're seeing that. But the fact of the matter too is credit card debt's the highest it's ever been. It's over $1 trillion now nationwide. So, there's a lot of going on plastic. And so it's an
That's
issue.
not a good sign.
It's not a good sign.
But I think I saw yesterday that as of the recording of this, which is in mid-August, I saw something about house sales being as high as they've been in the last 6 months. Last month, did you read that?
I did, and that's positive. That's
Yeah, it's great
obviously,
news.
that's always a good sign. Real estate's kind of the driver of our economy, and it trickles down to everything else. And so, people in homes and schools, all the things that go along with real estate is essential, in my opinion. And it will help, of course. The Fed, came out cryptically today, said they're going to lower interest rates next month, which we kind of knew all along. That's going to help mortgage rates in the future. So that'll also help housing and real estate.
Has the market reacted to that already?
Yeah, a little bit. Yes, they're
I haven't watched
they're happy. They're happy. So
Which again, since we're here talking about this, the what I'm going to call the blip in the market that occurred in the last couple of weeks, um, is that something that we should expect more of because of volatility, or was that just a correction that was ready to happen? That I've heard many people say is, look, things were just so overvalued. It was necessary for that to occur to help bring things back into more commonsensical places.
I think it is a natural phenomena in the markets. Unfortunately, we've been spoiled over the last 5-10 years with good markets. We've really, I mean, 22 was the first time there's only been 3 times in the history where the market and the bond market went down the same year. But for the most part, we've been spoiled, and a lot of it has been due to the amount of money that's been pumped into our system. And so for markets to correct and do these things, they should be expected, and it's not unusual. And people get, especially the younger, Glenn. Not that they're old guys in the room, but we've been around long enough to see multiple market crashes that have had significant influences on people's portfolios. There's not really been a huge drop in anything since like 2008. I mean, that was the big daddy, and of course the .com crash. That was horrible too. And so, these are cyclical things that are going to happen, and so you just have to be prepared. And when we tell people all the time, it's always nice to have some dry powder on the sidelines. So when the markets do that, whether it's real estate, stocks, or whatever, you have the ability to sort of allocate funds when the market's down.
Like the big earthquake, we're overdue.
Yeah,
we're overdue.
Yeah,
and
we are overdue.
Yeah,
and there's a great book out there on real estate that says there's like a 200-year cycle in real estate. Every 18 years, like clockwork, there's a real estate debacle or crash.
So 2026.
Yeah. So 2008 was the last one. Then the recession of the early 90s, that was the previous one. And you back another, it's very, very, so 2025, 26, 27, whatever that may, it's not going to be perfect, of course, but these are things that have historically been shown to be the case.
Keep the rental home.
Yeah, there you go.
Keep the rental home, because there's going to be a lot of people looking to rent rather than buy.
Yeah, right. Exactly.
Although totally. The argument would be that if the economy crashes and home prices crash, like you said, I think it was Warren Buffett and many others. What was the name of that book? Investing 101, Robert Gold. Oh, God, what was his name? It's bothering me. It was a great book.
That's one of the what's the name of that book?
It's one of the seminal books on
Goldstein. I think his name's Goldstein.
Yeah, I can't remember. It's a great book. It's a big, thick, gray book, but it's great reading. I read it years ago. And when everybody else, and Warren Buffett has said it many times, when people are running away from the market, you run in. When people are running to the market, run away. Yeah. Right. And right. Yeah, and it's just the way it is. So let's talk a little bit about your investment philosophy as a management company. What's different about working with you versus working with any number of big box traders? I'm not going to I'm going to throw names out that mean nothing in terms of, just so you understand, like I could go to Merrill Lynch and have somebody from Merrill Lynch who says, oh, I'm a financial advisor. Come to Merrill Lynch Financial Advising, right? And I'm not referring to them specifically, but they're one of many. Bank of America. I mean, every bank has an arm, everybody's got some
wealth
sort
management arm, whatever it may be. Yeah.
So what makes you different in the way you approach things and educate your clients versus these other folks who right now, many people are out there listening and say, I just as another example, I have Kane Waters manage my money, right? I do not, but there are many people who say, oh, I have Kane Waters, they're my accountant, they know my stuff, they're doing a great job. Yeah. What makes you different than the traditional folks who are out there doing it? And I would put all of those into the traditional model.
Yeah, those are all in the traditional model. And really the biggest difference between what we do and others is that the key to how money works is understanding how it works. And how money works is it only works when it stays in motion. Money's of no value when it sits in one place for too long. And in the traditional world, most people, whether it's, JP Morgan, Merrill Lynch, who are these groups, all they want is assets under management. And they just say, all right, give us assets. And they say, let it grow through time. But that's a very, very inefficient way of building wealth. And so typically when we see orthodontists and dentists come into our space, the majority of their assets reside in what we call one box. It's called the retirement box, whether it's 401ks, SEPs, or Simples. And then it's like, oh, I'm maxing that out. Then I'm doing the backdoor Roth. And then I'm like, oh, I can even put more money in that box. Let's do a cash balance plan. Those are all very, very inefficient ways of building wealth, because once the funds sort of move in there, it's not that these entities are bad, because everybody should have a 401k and retirement plan, but it's not everything. So how we look at it is that retirement planning is not a retirement plan. Retirement planning is everything, whether it's outside investments, outside stocks, outside bonds, crypto, real estate, private equity. You're talking about on your thread the other day about getting great rates of return. A lot of those comes from private equity opportunities, and there's tons of ways to have a retirement that is called full income replacement. Because when people go down the traditional path, and we've never seen it not be the case, every single time we meet somebody in the front end and we look at their numbers, it always comes out to be about a 40 to 60% pay cut in retirement. I'm like, how can that be? It's because It's because they let money sit in one place for too long. So our objective, of course, is say you should have no pay cut in retirement. You should have full income. Whatever you're making pre-retirement, you should be making in retirement. That's inflation proof. But the only way to do that is keep the money in motion. You just can't put it in one place and let it sit for too long, because you get crushed by the wealth eroding factors, things that like inflation, which has been very, very significant recently, or taxation. No matter what administration comes into the game, they all have their ideas about best way to, taxes. And so these things we can't control, but you have to be cognizant of. So when we look at people, we always say, how do we keep the money moving? See, the funny thing is financial institutions, insurance companies, what do? They keep their money moving. They never let their money sit in one place too long, but yet they tell us as the consumer, hey, keep your money in one place and don't touch it and let it compound through time. And compounding is not a terrible thing, but you want to make sure that some of those assets, they're working a little bit harder for you. So we always say we need to think like the financial institutions and the banks and the insurance companies, and not do what they're telling us, but do what they're doing.
Yeah. And I'm going to put you on the spot now. You ready? I love putting you on the spot.
Love it.
A few weeks ago of the recording of this, I made a post on Orthopreneurs about, it was about OSOs in general. And I was trying to make the example, and I don't know how anybody could argue this example unless you're going through a massive growth phase, that if I give you a big lump sum of money up front, you're going to do better financially in 20 years than if you get that same money over time. Like it's as commonsensical as anything. It's a truism.
Mm-hmm.
If I give you $1 million now, versus you making 50,000 a year for the next 20 years, or 100,000 a year for the next 10, at the same return, you can't even be close. It's not even close. And as an example to illustrate that, I said, look, if you sell your practice and you get $3 million in after-tax dollars in cash,
mm-hmm.
which is not a lot compared to what the deals I've been seeing are,
mm-hmm.
you have $3 million after-tax dollars, and you can invest that for 15 years. You could easily have $20 million in 15 years from your $3 million. Like that's, it's not even worth. First, I'll ask you, does it seem outlandish? I'm not going to say, how do you get there? But if I gave you $3 million cash right now, Mart, and said, do anything you want with it, I just don't want you to risk it like crazy risk, right? I want you to be smart with it, but could you get me 20 million pre-tax dollars in 15 years?
It's definitely possible. It's not outlandish. Let's put it that way. And you're right. The economics behind a lump sum versus over time is correct. The lump sum is ideal in the world we live in. The main thing is too. The funny thing about in the traditional world of finance, people always say, in order to get a high output, a higher rate of return, you need to take more risk. No, that's not true. Actually, you can actually, if you do modeling correctly, you can get a greater output, a higher rate of return with less risk. And that's exactly what the bankers and the financial institutions, they'll take bits and pieces over time, and they can multiply it and get double-digit rates of return with less risk. And so it gets back to the concept, we got to think like they do, not like what they're telling us to do.
Yeah, exactly. People are lemmings. And that's, if I said to people who are listening right now, how many of you are invested in private equity? I'm not talking about as a part of your sale of your practice, but you have money in private equity investments. The hands that go up will be very, very few, because number one, very few have access and very few have the funds. Many of them have a $500,000 minimum to get involved in them. But this is statistics. I've cited this. A top 25% private equity firm, not the best, not top 1%, not top 5%, but not top 10%. A top 25% private equity firm will return between 22 and 43% annually, folks. Annually, okay? That is not 4%, 6%. By the way, I just want you to say something out loud, and if you're uncomfortable saying it, I respect it, then I'll say it. You're going to sit down with your financial planner, Mart. He works at one of these traditional centralized bank sort of situations, and or he's your accountant or whatever, and they say, you know what? If you just put aside X amount of dollars and get 8% per year, in 30 years, you'll be ready for retirement, or 25 years, you'll be ready for retirement. What would be your statement to that individual at that moment, other than I will tell you where to forward all my financial data?
Yeah, I can't stand that story, because it
drives me freaking crazy.
It is so, there's so much misinformation in that, and you're not doing the client any favors by doing that, because it's just, there's so many inherent problems, so many, by making those comments. And so when people make those, I say just run for the hills, because it's not, that's not the most efficient way of building wealth, not even close.
No.
But that is what we're told in the world we live in, whether you open up magazines or you turn on TV and other things, because it's simplistic, and people tend to want to your point, they're lemmings because they don't know any better. And unfortunately, in dental school and orthodontic programs, we're not trained on any of this information. So, we just sort of do what everybody else is doing. And I've sort of never put myself in those shoes. I just always want to try to look in a different light. And so, yeah, those comments, Glenn, drive me nuts.
The worst part about it that drives me just crazy is you have really, really, really smart people who have their spreadsheets and they have everything set up and they're blah, 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 blah. And they're willing to settle for 8-9% per year. And they're just going to keep dollar cost averaging and putting money in. And don't worry, I'll be fine. It'll work out great. And right now, this second, there's someone listening to this right now who's going to, I'm going to speak to my financial advisor about this. And they're going to play this part for them. And the financial advisor go, they're silly. They're ridiculous.
Oh, yeah.
They're chasing returns that are not available. And I'll just remind you of the old saying that Bill Gates didn't get wealthy through the stock market. And I'll challenge everybody listening right now. If you are, and I want to use the word fortunate, though it's not really the right way. I'm not saying that you're fortunate for knowing this person, but that if you're fortunate for the example that I'm giving, that you're fortunate enough to be able to understand it. If you're fortunate enough to know somebody who's wealthy, I'm not talking about somebody who's doing well. I'm not talking about somebody who can retire. I'm talking about someone who's wealthy, whatever that means to you. And I'm talking the 8-digit barrier to their net wealth. They passed that ages ago, right? We're talking 9 digits in wealth, 10 digits in wealth. Like we're talking, fair amount of money, $100 million or more. Okay.
Yeah.
Which is kind of hard to find in ortho.
Yeah.
Okay.
Yeah.
They didn't make their money in the stock market investing dollar cost averaging. They didn't. Now you can make the argument that maybe they had one lucky deal. I knew somebody who invested in real estate and just happened to hit a home run with one giant piece of land that turned into a mall. And that one deal was worth $500 million.
Yeah, it happens.
But he had to own the real estate to even be in the game.
Yeah.
Right. And again, you can go invest however you guys want to invest out there. I'm just trying to bring you the advice from the people I know who are really, really wealthy, because the biggest part the reason I had that post in Orthopreneurs is there was something I was talking to somebody about when we were talking about OSOs, something Chris Benson told me, something I know you would agree with, something 2 or 3 other doctors told me who had already associated with an OSO. And again, crystal clear, I'm not telling anybody to join an OSO. You got to do what's right for you. But aside from the big lump cash that you will get up front, which clearly the earth must be flat because people are arguing with me on that one. Aside from the big lump sum of cash you're getting up front, one of the real major advantages that I found when you join an OSO is that when you go to the doctor's meeting, and I can only speak of Smile Doctors because Smile Doctors is what I joined.
Yeah.
And if anybody has questions, always reach out to me. I'll always be honest. When you go to the doctor's meeting, same boat. Mart's part of Smile Doctors as well. Yeah. If you reach out to either one of us, and by the way, you're a financial advisor who made the horrible, horrible money mistake of joining an OSO, Mart.
I know, right?
How dare you make that mistake? You're just proving what a terrible money manager you are.
I know. Horrible.
But if you were to sit in a room at a doctor's meeting at Smile Doctors, and I'm being dead honest about this one, and you're having a drink and you're talking to the other doctors, you will walk away from that meeting guaranteed hearing about investment opportunities that you will never, ever hear from your financial advisor, from your friends, because in that room, just because it is, by definition, every single person in that room, is, with the exception of the associates, has sold their practice, which they worked damn hard to build, and probably got a significant lump sum of cash that they now needed to invest. And they found themselves going from one amount of money in their bank account to a significantly higher amount of money in their bank account. And lo and behold, investment options come to you. And Chris Benson said this to me. When you have a bunch of more zeros at the end of your number in your bank account, all of a sudden, you're going to learn about investments that you didn't know existed beforehand. Would you disagree with that?
It's 100% correct. It's definitely true.
I don't know how I got involved in investing in private equity funds that have nothing to do with ortho. I don't know how I got involved in commercial real estate development deals that have nothing to do with ortho. I got involved in startups. I mean, there are places that just somehow Glenn is involved in a private equity fund that has, look, I'm just making up a number, that has a minimum investment number of $750,000. And they only take 50 clients, and they have a track record of massive returns year after year after year. Well, I'm meeting with Mart, and Mart, how you doing? Good. How's life? Wonderful. How's things good financially? Are all good? Yeah, amazing. Hey, by the way, I just want to tell you real quick, I got involved in this private equity fund. It's a lot of money to put in at 750, but I'm telling you, here's what their returns have been. Oh, cool. I'll look into it.
Yeah.
That's how this happens.
Oh, yeah. All the time.
All the time. But
it's crazy, actually. It just starts falling. It's like falling out of the sky.
Yeah. All of a sudden, it's like, hey, by the way, my brother-in-law turned me on to this company. They're about to turn your consciousness into digital, right? I'm just making something up, right? And they're looking for investors. You know, it's risky, but they're taking 50 grand, you know, if you're interested. And this happens. You may have this in your life, and if you do, fantastic. I do not. I don't know if you had it, Mart, but I certainly didn't.
Oh, yeah, 100%. And that in your previous point too, and then what I made comments too about what makes this different too is like for us, it's like all the above. Just investing in stocks is fine, but it's not. It's not the answer. It's just a piece of the puzzle.
Right.
And when you cobble all the different pieces of the puzzle gets to be pretty big. But if you're just sort of doing one thing and doing what everybody else is doing, therein lies the problem. You're just not maybe as good as you could be. And that's how it is.
Yeah, you're not as good as you can be. And I'm telling you all right now, and this is being aimed at those of you who think you really know investments. And I am not one of them. Okay. If you ask me about investments, I will tell you, I will refer you to some great people. I know what I'm an expert in. I know what I'm not an expert in. And I will refer you to Mart and a whole bunch of other people like him who are experts in this. But this is being aimed at the people who really think they know what they're doing. Okay. You're not anywhere near as smart about investing as you think you are. I'm telling you that now. You've got blind spots that you don't even know you have. And the people you're relying on more often than not are people who have a stake in your money that you are unaware of. There are things going on in this world that I watch where I wonder how, with a fiduciary responsibility, they're able to get away with it. But they do. And I would just warn all of you, when you feel you've got it all covered, that's when you're most vulnerable. And go speak to people. Mart, do I have any financial investment in your company of any kind?
No.
None whatsoever.
No.
So I'm telling people, call and speak to Mart.
Yeah. Just
talk to him. Find out, say, here's what I'm doing. What do you think? Now, he may give you advice that says, you are spot on. Keep doing what you're doing. He's as honest as the day is long, folks. Or he's going to say to you, you know what? This is what I would refer to as an uber conservative portfolio. And as a result, you have exposure here because you're betting on very slow upside, and all it takes is one downside to wipe out everything you've got and set you back 15 years like 2008 did for so many people.
Yeah.
Right? And someone pointed this out to me, and I know this is so common sense. You've probably used this many times, but it didn't really occur to me. If the market is up 50% and then down 50%, you're down what, like 20%, 25%?
Yeah. Well, a good way to put that is we say it all the time. It's like, as your advisor, I can give you a guaranteed average rate of return at 25% for every 2-year period for the rest of your life. Would you want that? And of course, everybody says, yes, I'd love to have a 20.
Every 2-year period?
Every 2-year period for the rest of your life, would you want that? But herein lies the problem.
Yeah, you don't know what the first year is.
Yeah, if the first year, if you have 10 grand and you go up 100%, you have 20 grand. And then the next year it goes down 50%. You're back at 10 grand, you're back at zero, but your average rate of return was 25%. So you have your average. I delivered on my promise. I gave you your average rate of return at 25%, but you have no more money. See, and therein lies the problem. When people start talking about averages, you got to run for the hills because the average is not reality. And so these are the problems that people get. They start chasing returns, and they're not even chasing the right return.
I know. I mean, but just think about it. You have $1,000. It goes up 50%. You have $1,500. It goes down 50%. You lose $750. You have less money than where you started.
Yeah.
And it took me literally, I was this age when I learned that this equation, I know it's so common sense.
It is.
And if it goes down 50% first and then goes up 50%, right? You have $1,000, you lose 50%, you're down to 500. It goes up 50%. Guess where you are? $750, right? So just remember, don't try to time the market. I learned that when I was young. there's so many isms out there. Here's one I learned. I'll throw past you. Tell me what you think. I remember Darrell Kane way back in the day, back way, way, way back. I'm talking like 20 years ago, if not more. I remember he gave a talk on money that was so powerful at the time. Uh, it blew me away. And here's what he said. And again, I'm not speaking for current day Kane Waters. I'm just telling you about. I'm not endorsing or going against anybody. I'm just telling you this was Darrell Kane speaking back in the day, personally, and said three things: until your return on your money matches 1 to 1 the amount of money you're putting in every year, capital preservation is key. Meaning, if you're putting in 100,000 a year, until you get 100,000 a year in interest every year, don't invest in risky investments, because maintaining your capital is the number one name of the game as you're building it, because of what we just talked about, right? All too often you hear people speak the opposite. You're young, you can recoup,
You
risk,
know,
shoot for the moon, right? Would you agree that when you're young, capital preservation is key?
absolutely. So there's something we call the exponential curve of life. And it starts very low. It takes about 18 to 20 years for that curve to start taking off. We only have one curve in our life to do it right. There's no makeups. And
Oh
so
man, I'm out of luck then.
So if you were, if, well, the problem is like when errors happen on the front end, you're just chopping off the back end of the curve, right? So it's not that you won't have a good curve, but it's just
Right.
one of the things that capital preservation on the front end. It's important at all stakes of life. But the thing is that you just want to not take any missteps. And unfortunately, there's a lot of missteps out there that get presented. And as we said, you don't really need to take too much risk. You can do very well by not doing that, actually.
Yeah. And the second thing he said in that really powerful talk was when your rate of return to what you invest every year is 3 to 1, you're investing 100,000 a year, but you're getting back 300,000 a year in your portfolio from traditional investments. We're not
Hmm.
talking about
Yeah.
things like real estate or what have you. When you're getting back 3 to 1, you no longer need to be investing anymore. Now you can manage your investments because you're getting back 300 every year for the
Hmm.
100 you're putting in. Take the 100 and go on a world cruise. Take the 100 and go invest it in, a new boat, a new
Yeah.
car, whatever you want, because that 100 you're putting in is not moving the needle anywhere near enough to prevent yourself from being able to enjoy that money, because you're getting 3 times that every year, and that's
Yeah.
growing.
Yeah.
It's only going to get bigger and bigger. And again, my guess is for you to be getting $300,000 investment on, you know, 10% rate of return, just using a simple round number,
Mm.
you have 3 million invested.
Yeah.
Does the 100,000 you're putting in make such a big difference, knowing that next year you'll have 3.3 million, then you'll have 3.63 million, then
Hmm.
and the 100,000 you're putting in could have been used to throw a wedding, it could have been used to go on a trip, it could have been whatever the story may
Be
be.
charitable. Yeah.
Yeah, be charitable, exactly. Do you disagree strongly with that, or do you think it's a decent sentiment?
No, I like that sentiment. I think one of the biggest problems that people have is that we don't work all our lives not to enjoy it. So that there's definite money has no value unless you're actually using it. And so if you develop strategies, whether it's that strategy or other strategies, more always gives you the opportunity to spend and enjoy your wealth. And then also without, the greatest fear in retirement for most people, most Americans, consumers, is running out of money. So, if you can spend and enjoy your money without the fear of running out of money, that's kind of a really, really powerful thing. And so when you
Yeah.
sort of have these types of strategies in place, oh yeah, then you can sort of really start enjoying the fruits of your labor
Mart,
and
I
the
really
fruits of your
love
investments.
I love the time with you. I could do this all day long.
Yeah, I love it too.
I'll tell everybody it's a great book, Money and the Meaning of Life by Jacob Needleman. It's over 20 years old. Read it many, many, many years ago. And once you master what he talks about in that book, it's not an easy read. I'm telling you all that now, but you need to read this book. Once you realize that money is just a fungible asset, it
Yeah,
comes and it goes. It has no emotion attached with it. It cannot make you happy. It cannot make you sad. Only you can do that. The moment you divorce yourself from money playing any role in your happiness, you're free. Because then you can say, you know what? I've got a pile of money. I'm just going to start spending it. I'm going to start having fun. I'm going to start enjoying it. Oh, I lost a ton of money. Who cares? You're going
right.
to make more.
Yeah,
You're going to make more money. Money comes and goes. As long as the people around you are healthy, safe, secure, as long as you're okay, that's the only thing that matters. Read this book. It will hopefully change your life. And Mart, I just want to say thank you from the bottom of my heart. If anybody wants to chat with you, what's the best way to get a hold of you?
Two ways. Email's one. It's MART at macro, MACRO -wealth.com. I have a weird
macro-wealth.com.
I have a
Mart
weird first name. I'm one S short of smart. One S short of smart. So. And my, if you want to text me, you can text me or call me. My cell phone's 847-363-5502. I have no problem with that either.
Nice. What I love the most about this is I don't buy into status quo. I just don't. When I talk about OSOs, people attack me. I guarantee we're going to get arrows thrown at us from this, and it's going to be awesome. There was somebody who did a podcast episode. I don't even know who this person is. Sort of lambasting me about saying, $3 million turning into $20 million, and OSOs are a good thing, right? And I'm just like, people fall into the trap of thinking that I really give a crap, and I don't mean it the way it comes out. When I post something, I take it, I write it like a poet would write a poem. You throw it out there. Sometimes you take it very seriously. Sometimes you don't. So when I see people getting upset and angry about it, I kind of giggle. It's not a trap I'm setting for anybody, but they fell into the trap of thinking that I really give a crap, right? Like I throw everything out there because I want to introduce people to new concepts and make them think outside the box. I want people to feel pained when they sometimes think about some of the things I talk about and maybe think they're impossible or silly or ridiculous. But it's the mental exercise of starting these conversations like we 100%. Just had that get people thinking outside the box and not being automatrons or worse, closed-minded people to where they shut down things and think their way is the right way. Yeah. There's a whole world of opportunity out there, folks. Yeah. And the one that your accountant or your financial advisor is telling you is not necessarily the only one. My hope is that you're all doing great financially and that you're saving properly and that everything you're doing is maximizing your money multiplication, as Tony Robbins would say.
Yeah. Yes.
But remember, there's always different ways out there. And I'll leave you all with this. Tony Robbins said it best. Poor people see money as a means of survival, paying their bills and surviving day to day. Average, normal, middle-class people see money as a way of getting credit for things they can't otherwise afford. Wealthy people see money as a way of making more money. Remember that, people. That's the lesson about money for today. And Mart, wishing you a great day, my friend.
You as well, Glenn. I really appreciate it and really enjoy sharing this message. We think the same way on these things, which is really fun.
Because I've learned from you. That's why. And get his book.
Yes.
Get his book.
If you want the book, I'll send you a copy. Even if you want the book, I'll send him a copy or just get it on Amazon. Either way.
Text him or message him and get his book. It is definitely worth reading. Much love, my friend, and we'll talk soon, okay?
Yep, much love to you too, Glenn. Have a good one. Cheers.
Bye-bye.